Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go in to Twitter, see what they're talking about. I'm going to give you my financial opinion. We're going to go a little bit over some stuff that I also paired up with some of these statements so you guys have a better understanding of how this all works together. If you guys need help during this commodity bull market, definitely hit up finding-value.com. Join the Platinum membership, use the word discount in the coupon code, get yourself a discount. And you guys can join us in that community of a bunch of investors. We talk a lot on Discord. We also have Platinum question and answer sessions every weekend that you can ask me questions directly. It can be about individual stocks that you want me to look up, and we can look at the technical charts or anything like that. So let's dive in. I'll give you my financial opinions here. And if you want to follow me, it's at finding_finance, if you'd like to follow me. So I think he pretty much has this nailed down, and I'm going to talk through it with the real estate cycle. So hopefully you guys can see this. I'll blow it up as much as I can. It says, the cycle of markets, financial conditions ease, stocks rise, commodity prices rise, inflation expectations rise, rates rise, dollar strengthens, financial conditions tighten, stocks fall, commodities fall, inflation expectations drop, financial conditions ease. And that, for the most part, is the cycle, the big picture cycle. So if you were to overlay this cycle with the 18-year property cycle, so when they ease, they typically ease, you get this recession or pullback. They ease right at the beginning of this guy here at the end of the recessionary phase and the recovery phase. So when financial conditions ease, you see a low inflation, low interest rate environment. And that environment typically lasts for 7 years. So it lasts for 7 years. The market, because of the demographics coming into home buying years, the market tightens up, the inventories dwindle away, and what happens is you have to build new homes in the system. You have to add new homes into the system to satisfy the demand, because the demand cannot be satisfied with the current supply in the market. So you transition from a recovery phase into an expansionary phase on the back end. The thing that makes this all messy for this potential cycle is during this phase here, this mid-cycle wobble, they call it, it's all jacked up. They printed a whole bunch of money. They did QE to hold interest rates down, and they caused a large imbalance in the middle of this cycle with holding those interest rates down, giving a bunch of money out, and then people going home buying crazy at some point. Now, you don't end the cycle with that type of condition existing in the middle of the cycle. You end the cycle in a hyper supply phase. Basically what happens is you build far too many homes, you get a bunch of inventory, a lot of inventory, and it's new homes that are completed, not the 8 months that everyone shows where only 2 months of the homes are completed. It's where you have too many homes, and when you lower interest rates, the supply is still there, and the house prices do not come back. They are put into a supply glut, where even if you lower interest rates, the demand will not come back to satisfy the supply glut. So prices have to fall. Now, what I think is happening is that we're in the middle of this cycle here. They did all of this. They shut down the economy. They threw a bunch of money in it. They did QE to lower interest rates, and that caused home prices to spike rapidly. But those prices are normalizing to some extent. But if we were to lower interest rates right back to like 4%, 5%, whatever it is, the real estate market's going to kick back on because we're short in supply of homes. Now, if we were at the top over here, you would lower interest rates and home prices would still go down. That's really the difference between the mid-cycle wobble and a supply glut. So what's happening here is sometimes when they raise interest rates in this general vicinity, like they did in the year 2000, 2001 era, you get a pullback in kind of everything, especially if you have an interest rate that went up as fast as they could and affordability pulled back. We still have a shortage of homes. So the home prices are coming back down because affordability. I wouldn't have expected that because the previous cycles did not have this large of a mid-cycle wobble. They were driven, and I'll say the sustaining factor in those other markets were the home prices alone and the interest rates chasing the inflation from the real estate market. This time we had a bunch of crap thrown in it, which I think interest rates are probably a hair too high, and that's basically what the market is trying to figure out and stabilize. Once it stabilizes at some point, because inflation is not sustainable at the rates that they were, because it's not coming from the real estate market. It was coming from the real estate market and QE, lower interest rates, and the stimulus money. That'll work its way through. This will stabilize at some point, and then I think we'll go into higher home prices into the future. And I know that's counter to everyone else, but you don't, in my opinion, you don't end a property cycle like all of the other cycles. They all ended with too much supply. We're going to have to wait and see if the supply goes up. If interest rates stay high, then yeah, perhaps we could see a pullback in real estate for a short period of time. But if interest rates go back down, does the real estate cycle kick back on? In my opinion, yes, it would kick back on. I don't think there's a lot of buyers out there waiting for interest rates to come back down, and I think it would get kicked back on. But that's my opinion. That isn't a fact. So this is true what he's saying here, but I think where people get it wrong is stocks rose for 11 years. That cycle was 11 years long. Commodity prices are going to rise for 10 or 11 years. The inflation expectations rise, the rates rise, and we may have this happen multiple times in this cycle that I was showing you. Rates rise in here, we get a mid-cycle wobble, it comes all and kind of stabilizes, then we go back into another big expansionary phase of real estate, which is inflationary. Michael Burry even said, yeah, inflation's going to come back. And that's where I think it's going to come back. It does come in waves, and we in the 1970s, those waves were, I think, also interest rate driven and demographic driven at the same time. And the demographic did wobble in the middle of that demographic. So it's hard to say that the demographic didn't cause that, or if interest rates caused that. It's difficult to put, which one actually caused that. But usually you get an interest rate response, just like the early 2000s. You get a pullback, and then you get another larger run after it. We haven't had a 7 years, or if this was 11 years, we haven't had an 11-year run in real estate to catch back up this cycle and to create that oversupply or hypersupply phase. That's at least my opinion there. The London Metals Exchange is running out of zinc. It may already be too late, as it takes 10 plus years to bring new mines online. So this is the zinc warehouse stock levels. They're incredibly low. It's like this for a lot of different commodities: copper, zinc, cobalt, nickel, aluminum, etc., 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 whatever it is. Now, here's the problem they have. When you go through this cycle here, almost always what happens is you get this commodities fall area. Generally, the commodity sector doesn't oversupply as well, and inventories get filled back up. So in this cycle, when we see this cycle here, and you look at it, during this cycle, commodities, basically, you get a bunch of mines come online, generally speaking, and they overproduce. So you get this supply glut, not only in, we'll say, credit and inflation and in the houses, new home builds. You also get a supply glut in commodities. But here's the thing. We're like located in somewhere in this mid-cycle region, and we have no inventory of any of the commodities. Nothing's been solved in the real estate market or the commodity market. So if they try to ease financial conditions, they can't, because all that money is just going to flow straight into commodities, because that's where all the problems are at. And another thing that kind of makes this a weird cycle, or maybe it's just a little bit different, China is a large consumer of commodities, and they've done stimulus money. They've already done their financial condition easing, and they're going to be eaten through commodities. And when you've got commodities at these super low levels of inventory, I think what you're going to see is inflation. Inflation of commodity prices, which is going to hit the consumer price index numbers. And I don't think it's going to be, I'm not sure how bad we've gotten some of these inventory levels down to these levels. I mean, this was pretty low in 2019, and we'll see how far down we get it for zinc. So coming on down, it says nickel of backwardation. He's talking about oil. He's there. It's in a nickel pricing of backwardation. We did it. It says public service announcement. The 1-2 contango in Brent is now down to a nickel. Thinking we inflect to backwardated next week. Supply is about to get tight, very tight. So that's what I'm talking about. Commodities. It's going to get tight, and that's going to bring back consumer price inflation. So what the Federal Reserve is trying to do is they're trying to raise interest rates to stop this cycle from coming. Because if we're mid-cycle, they're trying to hold this down by decreasing the affordability of this cycle. That is what they're trying to stop. Now, they can be successful in stopping this, bringing it up to an unaffordable level. They hold this down, but what's their next act? What are they going to do in this mid-slowdown cycle? They're slowing it down, raising interest rates. Are they going to hold it there for 5 or 10 years or longer? Maybe, but they're going to have problems with rolling debt over, which is going to be inflationary if they print money to cover the interest payments. They're kind of screwed anyway. They're backed into a corner, an inflationary corner that plays out over time. They're going to have to let this cycle run out, which is going to also be inflationary. So the percent of stocks above the 200-day moving average provides a longer-term indicator of market breadth. Bearish divergences in late 2021 preceded the 2022 correction. Upside breakouts from 2022 bottoms and entering 2023 are positive in potential. So we can see here the bearish divergence as we're making higher highs. We had the majority or percent of stocks above the 200-day moving average really start to go bearish. Now, when we look, we've got a double bottom here, and I've talked about this double bottom before in our daily updates in a bunch of different stocks. Here's it clear as day in terms of the percent stocks above the 200-day moving average, and now we've done a retest and we're starting to move higher. And that this here precedes the movement in the, what is this, the S&P 500? Yeah, S&P 500 index. So we're probably going to go higher here for the S&P 500. That is what it looks like to me. That's what we've seen in the charts. That's what I've talked about. The home builders look like they're good to go. We saw a bottoming type pattern in Bitcoin, Ethereum, et cetera, et cetera, et cetera. It says, when called the 48-year commodities low back in April 2020, we said we were all really lucky bastards just to survive and be there. Also said back then, platinum will be a leader in this commodities bull market. It's pioneering a platinum case on FinTwit. Last up move lasted 25 years. It is now has a purple back test. So this was the 27-year bearish rising wedge. This thing, in terms of the ratio, platinum had outperformed since the 1970s all the way to a peak, which this is a Batman top. The Batman top went all the way to 2.2. We went into a consolidation phase down here, and now we've broken out. We've done a back test. That's here, and now we're starting to move higher. This is a false breakdown for this move lower, and that's where I piled in in 2020, late 2020. I bought as much as I could. I even swapped some metals for platinum. I swapped gold and palladium for platinum in April of 2020. Now we're starting to move higher. What this takes is a bunch of sitting and doing nothing. You position, you get your large positions. I bought here, here, all through here. I bought a bunch. I even bought some in 2019, right at the bottom here. Coming into that corner, I cost averaged in, and you sit on your hands and do nothing. If platinum does what it does back in the earlier cycles, if it reverts to the mean, platinum's going to outperform every other metal massively. Massively. If it reverts to the mean. Here's Cornerstone Analytics. Tons of oil energy bears out there, but energy stocks are almost back to all-time highs. While crude WTI is down $40 a barrel from June high. So what'll happen to energy stocks when oil prices rally? And they will rally. We're breaking this downtrend right now, and we're starting to move up. And XLE is up around highs. Now, I know some of the companies that we have, they are down a little bit. We have more of the mid-cap, small-cap type companies, and they're going to go ballistic when WTI goes ballistic. They're always a laggard of the larger companies. So XLE really hasn't dropped very much, and WTI is about to take off again. I think we're going to see a large outperformance of the companies themselves versus the underlying commodity for a bunch of different sectors. That can be oil, it could be natural gas, it could be energy services. Kevin says, load up on, SPUT and uranium ETF and look back in 2 years. I agree. Uranium looks like it's breaking out as well. So we've got lots of good stuff right ahead of us. Here's one. It says, the energy sector as percent of the S&P 500 hasn't even reached the previous bottom set in 1999. Another 30% plus per year, or another 30% plus year will definitely get us there. So if you look at 1999, we were at 5.6% of the S&P 500 for the energy sector. That peaked out at 13.3% at the end of the bull market. We got all the way down to 2.28%. We're at 4.85, still below the beginning of the bull market in 1999. And I know some people ask me, is it a good time to buy? Is it still cheap? Yes, all of these things are still cheap. I mean, energy service companies are so cheap, they're off the page. It's ridiculous where these companies were at in 2020 and 2021. We are just, I would say, getting to the beginning of the bull market, and a lot of these companies are putting in bottoming patterns, and they've just completed gigantic bottoming patterns. Inverted head and shoulders. We've got double bottoms. We've got, we'll call it pennant formation bottoms. They're all over the place. We've got volume increasing. Everything you want to see from a picture-perfect technical perspective of a bottom is basically being performed right now. So, yeah, I'm super bullish on energy service, uranium, and a lot of other commodity sectors. Now, here's something else that I thought was kind of cool. It says, here's something you don't see every day. This is a communications index fund. It's not commodity driven at all. It's the worst performing sector of last year. We came on down. We did a double bottom. We know this, guys. We've seen it you guys know this. If you're on the website, you know what these bottoms look like. We've got that little resistance area, and what? It is new 4-month high. We're putting in a bottom. What does that mean? I think we're going to see an everything rally. I think that's what we're doing. It's going to be an everything rally, perhaps. And this is 22.5% weighting of Meta and 24% in Alphabet. Here's another one that says, the way I see it, if energy stocks couldn't correct in an environment where crude oil prices are collapsing, how will energy stocks do with the more stable oil prices? And this guy did something very similar. You can see the roundish bottom that we've got going on and potential move to the upside. So I have to share this with everybody. So the U.S. housing bears updating crash predictions to minus 40%. We've got this square block and a round hole. Let's see what this is talking about, what's going on. So He says U.S. housing prices compared to, say, Canada and Australia are very reasonable. Even if you have speculative pockets in California and Vegas, as usual, I just don't see the broad-based housing crash the next 2 years, according to him. And this is the regional home builder price reduction since March 2022 net of incentives. And you can see greater than 20% reductions. You can see Northern Cal, there's a little bit, but there's not too much massive reductions going on of greater than 20%. There's minus 11 to 20%. Yeah. We've got minus 1 to minus 10. That's the majority in this yellow area here. So yeah, they're pulling back, but it's not like earth-shattering pullbacks, at least not yet. I think it's due to the affordability of the interest rates at this time, and I think they went too high. I think they'll come back down to some level, and it's going to kick this all back on. But that's my opinion. That's just an opinion. It says, meanwhile, ITB is up over 35% since June. Probably investors preparing for an economic collapse. So let me go back. Now here's another one. It says, big problems with copper production. King Industrial Metal is the canary in the coal mine for gold and silver. When copper inventories really decline, panic buying will occur. The same thing will eventually make it to gold and silver. So Chile's copper production, look at this decline in copper production, guys. This is at 13 billion pounds roughly, and now we're coming below 12 billion pounds. So we've got a decline in copper production even. This is going to get real hairy here in a lot of these different commodities. In mid-2020, that's when a lot of different commodities come into these deficits where a lot of people think that they're not really solvable. And I don't know what that means in terms of prices. I don't know if everything just starts going ballistic that hits these deficits where we get these shortages in the market. We'll see. I don't know if we've ever seen this before. Usually what happens is you get a little bit of a deficit and then supply responds quite quickly to prices. We've got prices going up and we're getting the opposite effect where production is actually declining. And that, I think, is going to happen in a bunch of different commodities. The possibilities there. I don't know what the supply response will necessarily be. I don't think it's going to be like previous cycles. I think we could see some little super spikes in the short term for certain commodities. This was another one. This is a chart for the oil bulls. So who's right, copper or Brent? Copper's taken off. That's in the red. Red's taken oil. And what do you think oil's going to do? It's probably going to follow copper. Copper's been the leader here. And I think with the declining falling wedge in oil that it's going to follow copper higher. And you can see the relationship of copper and oil together here. And sometimes copper leads and then oil follows. That's generally what happens. You can see copper led here and copper's leading to the upside. So we think oil is going to lead here, or oil is going to follow copper's lead. So I thought that was a pretty good chart there. Here's another one I think is pretty cool. Commodities are a risk-on mode. So we had this pullback here. You can even do a trend line lower, and we're breaking out to the upside of this trend line. For all you MACD guys, and I'm not really a MACD, I don't really care about it, but we are bottoming the MACD, and it looks like it's ready to turn and move higher on a 12 and 26 EMA movement, week movement. So commodities look fantastic for a move higher in the short term, medium term, and even the long term on all time frames. We're seeing this also with copper breaking out, with the overall markets going higher. It's all lined up and in agreement with each other. Here's something else that I think is cool. Have said, even before I called the commodities bear market low back in April, I think platinum will outperform both gold and silver in this bull market. If silver's a 15x from here, imagine where platinum would be if this ratio goes back to all-time highs. And here it is, real low at 43, and all-time highs were at like 200 intraday, or intra-month, I should say, or intra-year. But it's got up to about 140, good shot there, or higher. That means that platinum, if silver does a 15x, and I'm just using his numbers for the example, platinum could outperform silver by 3 or 4x. That's kind of what's happening there. So if it does a 15x, platinum's going to do 3 to 4 times that. That's the opportunity there. and I've positioned as such to take advantage of that. And that's what I'm going to end there. So I'll end it there. That's kind of all commodity related stuff. Hopefully you guys are getting a lot out of this. A lot of good information that we went over today. I do think that energy and that's uranium, oil, energy services, all that stuff, it looks like it's going to roll higher. Gold, silver, platinum, all looks good. Basically everything I look at looks pretty good. Even the overall general markets look good. So I do think that interest rates could come back, and I think it will turn on the home builders and the housing market back on. That is a speculation. We'll see if that happens. If interest rates were to go down, if they hold interest rates high, they're going to hold the inflation rate low. So I would say that they are successful in creating the potential outcome that they wanted with the increase of interest rates and the affordability of housing. But that is a step one. What is the second step of their play? If they lower the rates, they're going to get that inflation to come back. If they keep rates high, the interest payments and all these other payments are going to kick back up when debt rolls over. And they could have other problems and other inflationary problems with that. If they have to print money to release all this stuff, they may even have to engage QE again to buy bonds. We'll see what happens. Very interesting dynamic going on. So that's what we've got for today. Hope you guys enjoyed it. Give me a thumbs up. Subscribe to the channel if you haven't. And we'll catch you next time. This is Finding Value.